Joining me in studio today is Aashish Somaiyaa, who is the Chief Executive Officer of WhiteOak Capital AMC. Ashish, thanks as always for taking the time, and thanks so much for coming to the studio.
Thank you. Thanks for having me.
So, you know, that saying, we live in interesting times, I don't think that has changed over the last several years, and that continues to be the case. But as we head into the next year, what are the key factors that you're paying attention to?
So, I always tell clients and advisors that, the risk is in your portfolio, the risk is not in the markets, right? It's very natural and very normal for everybody to look for risk in the markets. So, everybody, like you rightly said, that, something will change when the presidency in the US changes, correct? But unfortunately, it's very difficult to forecast, right? Like, I'll give you an example. Somebody was telling me, and a lot of people say this, that when Mr. Trump becomes the president, then how will it be for China? How will it be for geopolitics? So I asked the guy, are you the same person you were 4 years back?
That's a good question. And that certainly the answer is no.
Yeah. So our views change. And we are ordinary people. I mean, you're talking about the American president, right? So his views change, his team changes, correct? And it's known that he's somebody who believes more in bilateralism and in deal making rather than multilateralism and, the world order and those kinds of things. So yeah, some things will change, but the reality is that we don't know what goes on in his mind and what goes on in Mr. Musk's mind, and it's not possible to forecast, correct? So that's why I tell people that everybody looks for risks in the markets and everybody looks for risks in a Trump presidency, whereas the risks are pretty much in your own portfolio, right? So getting to the point, like, why did I say this, is because if you see, forget all of this and look at client portfolios. I'll give you just a simple example. If you take the market cap, the equity market cap, you'll realize that in the last 15 years, on an average, large cap has been 70% of total market cap, right? Right now, large cap is 61 or 62%.
Yes.
And somewhere in 2013, large cap was 77 or 78% of total market cap. So now, Alex, if somebody says that, I'm a neutral investor, I'm not aggressive, I'm not conservative. So my large cap allocation should reflect market weights. If I'm a very aggressive guy, I'll have more money in small and mid cap. If I'm a very conservative guy, I have only large cap. But somewhere for a moderate guy, your portfolio allocation should reflect the broad market. And then you may be, some plus minus. But in the last 12 months, till 31st October, in 12 months, mutual fund investors put 3.5 lakh crores into pure equity funds.
Yes.
Take a wild guess how much of that was large cap.
I know that most of it was sectoral and thematic funds.
It's only 4% large cap. So if you add 50% of large and mid cap funds and 60% of flexi cap funds and 30% of multi cap funds, and you do all of that, you'll realize that less than 20% went into large cap funds. Like you rightly said, 40% or 50% went into thematic funds, and then a whole bunch into small cap, mid cap and stuff, right? So long story short is that, look, you and me can keep debating about Trump presidency, but if people are going to put all their money into micro cap, small cap and few themes like defense, PSU, energy and utility, then you know where the risk is. It's not in the presidency of US. The risk is already in your portfolios, right?
So then let me ask you this, Aashish Somaiyaa, you as an investor, of course, you have your own risk profile and your own requirements for why you invest. But as you get into 2025, are you tweaking your portfolio in any way? Are you anticipating that certain things will change? Or have you already done that, expecting that things will change?
So, if you ask me, say, what I have been telling people and what I would do for my own portfolio also, is that, get the portfolio into the center of the market. Right? The market is very much 60-70% banking, financials, IT, consumer, healthcare, and all these kinds of things. Like I already said, the market is pretty much 60-70% large cap, right? But what is happening is that people's portfolios have been getting allocated more and more into some corner, crack, or crevice of the market where they think that they're going to get outsized return, right? And in the last 3 years, rightly or wrongly, in the last 3 years, that's worked for them. But like we spoke earlier, you have to shoot where the rabbit will be, right? Not, where it was. So I would tell people that bring the portfolio back into the center, meaning that, get a bit more neutral weight when it comes to the market. You're definitely underweight large cap. So rebalance in favor of large cap. you're definitely in all the hot sectors of the last 3 years, which were the high beta, cyclical, commodity, the conglomerates, and the PSUs and stuff, right? In the last 5 years, the banking and IT index, and say maybe consumer, they've underperformed Nifty. This defense, PSU, etc. has given 3 to 4x of Nifty. But if you see the last 3 to 6 months, the market has already reversed this. The darlings of the last 3 years are 20-25% down from the 52-week high.
Right.
And the non-consensus laggards or dogs, they are 20-25% up from their bottom. So it's not so much a market correction. The headline Nifty may be 7-8% down. But there is a violent rotation and there is a correction which is already played out. Look, the Nifty may not correct, but if your favorite sector is 20% down, and the sector you're not even looking at is up 20%, it's a correction.
And for you, it's
a massive
definitely your
correction.
portfolio is going through something. Yeah.
So I'm just saying that, for next year, before next year, I would just tell people to revisit their asset allocation in all forms and formats, whether it is large cap, mid cap, small cap, whether it is a sectoral balance, whether it is overexposure to equity. I think we've had a dream run. I'm not pessimistic about the upcoming year or so, but I just feel that, you can't keep playing a soccer game in the penalty area. I mean, for 70% of the time, you're passing the ball and it's the middle of the field. I mean, people have been in the penalty area for far too long.
That's a fair point. Speaking of rebalancing, this is actually a question that I'm asking more representatives of mutual funds, either from the actual management side, or of course you will also have a perspective on how the fund manages the money right now, what the strategy is right now. What is the BAF strategy right now? In that, is this tending more towards underweight on equity, more on fixed income? And the reason I'm asking, the context of course, is that today we had a brokerage saying we could see a cut in interest rates when the RBI Monetary Policy Committee's outcome of the meeting comes out tomorrow. Of course, that's way too near term. But directionally, we are heading into 2025 with the expectation that interest rates are going to come off. That's good for bond yields.
So, I think this is all a bit counterintuitive. Like, see, till now what is happening is we actually got less than anticipated earnings data.
Yeah.
We actually got, unexpected GDP numbers.
Yes.
Right. And the market is stoic or, Teflon coated.
Yeah.
Correct? And people are expecting that maybe some liquidity adjustment, but they don't expect RBI to cut rates. Now, how the market works is that if RBI cuts rates, people will think, oh, gosh, what do they know which we don't know?
Yeah.
So let's not jump to conclusions about any of this, right?
Sure.
I mean, if there is an equal chance, smart guys will say, oh, maybe it's worse than we thought. How come these guys have become dovish, right?
Yeah.
So all these macros are really tricky, tricky. It can cut both ways.
Sure.
Correct? You see, we spoke Trump presidency. In 2016, market was nervous Mr. Trump might win. In 2020, market was nervous Mr. Trump might lose. And now market is excited that he has won. So I don't give much credence to...
It's like reading tea leaves, is it?
Yeah, I mean, it's just market has moods, correct? So I would put it this way, that, even the monetary policy, I mean, it'll be good if they act on it. It's good if there is a change of stance, but I don't think that the market is running away in a hurry. Market has been on a tear for quite some time. You asked about balance advantage.
Yes.
So some parts of the market has been on a tear, but look, funnily, if I look at Nifty, 5-year CAGR of Nifty is 15%,
Yes.
and 5-year EPS growth of Nifty is 16-17%. So why I said come back to large cap? Nifty on its own is not looking like it's crazy, because there are some components of Nifty which have given 2-3x return, and some parts of Nifty which are underperforming.
Yeah.
So when I say rebalancing, it's just that get to the cheaper parts of the market, get to relative value, and our balanced advantage fund is indicating 53-54% equity, which is not aggressive, but definitely we are not, running away.
Understood.
So all of this is just about reducing risk in the portfolio, not entirely leaving the market. That's the point.
Because the Nifty 50 ultimately is less than the 5-year average at this juncture.
Yeah, exactly.
So, interestingly, another aspect is the steadiness and continuity of investments. And I'm speaking to you about this because it was indeed WhiteOak Capital's study on SIPs and continuity of SIPs. Ultimately, that strategy has stood the test of time. You want to go through that?
Yeah, see, if you really see the whole learning, if you take the whole history, it's, let's say in March 2023, when we had that Silicon Valley Bank, Signature Bank, etc. Now today, if you see, people are consistently investing 25, 26,000 crores per month, right? We'll get November numbers, we'll see. But I can remind you that as recently as March 2023, if you go back and see the discussions, there were some signs of people stopping SIPs and people thinking, look, I'm contributing for 12 to 15 months or 2 years, and now, after 2 years, the value is negative. So every once in a while, these kind of things will come up. But ultimately, why do we do SIP? We do SIP because there will be a point in time when market will do something unpredictable and we need to invest at every level, correct? So, I think right now people have been very, very consistent. You are seeing consistently rising SIPs. You are not seeing failure rates or stoppages.
Yeah.
So this is great. But I think people need to keep that in mind if there are any eventualities which we don't know about. That's the key.
Okay. Last point, and I've spoken to your team about your multi-asset fund as well.
Yeah.
And it's an interesting take on the multi-asset fund. It's not conforming to what a lot of people are doing in the sense that it is diversified and truly diversified in that sense.
It's a genuine,
Yeah, so what are the strategies that are being employed there that you can probably take through to the rest of an individual's portfolio if required?
See, I think one of the biggest mistakes which people make with multi-asset funds, everybody, advisors, AMCs, investors, generally, that's just my perspective, that a lot of people make this error, which is that they have some presuppositions of how an asset class will do.
Should do, yeah.
Correct?
Right.
That's not the point. I always compare asset allocation to chemistry, right? If you mix 2 or 3 different substances, it produces a 4th substance.
Yes.
The 4th substance doesn't look like any of the 3 which you put in as ingredients.
Yeah.
It may derive some properties from each, but when it combines all of those, it has a different life of its own. It looks very different.
Yes.
Correct? So that's how asset allocation is supposed to behave. So what happens is today, if, like say in our asset allocation fund, we didn't start with any presupposition that gold will do well or that we should have equity 65% because equity taxation.
Yes.
We didn't do any of that.
That wasn't the objective.
That was not the objective. We just started building it ground up, saying that, okay, if we want low volatility and we want something which will be an option for people who otherwise find it a struggle to put money in fixed income. See, there was a point in time people used to put 3-year money into corporate bond funds and gilt funds and so many of those things.
They don't do that anymore.
Right? Now they don't do it because it is fully taxed.
Yeah.
So you have to artificially construct an asset allocation such that it will give you the low volatility experience if you hold it for a couple of years and it can give you acceptable rate of return. So then the allocation comes very different.
Yeah.
It comes like, more like 10 to 40% gold, 15 to 45% equity. So just take an example. Last 3 months, a lot of multi-asset funds have given negative return. We didn't give negative return.
Right.
In the month of October, BSE 500 was down 6.5%. Our return was positive. In the month of November, gold was down 3.5 to 4%, but our return was positive. So I'm not saying that you should assume it will give positive return every month, but I'm just saying that asset allocation should be viewed like chemistry. Right?
And it's downside protection.
Absolutely.
The last point that I want to raise with you is because you have the pulse again, and we are on the 5th of the month, we will soon have the numbers, but there were murmurs that said that, of course, October nothing happened, the numbers were spectacular. November, perhaps there was a little bit of selling. What was visible in the kind of trends that you saw?
So see, when you see the numbers, I would imagine, I won't be surprised if there is a reduced gross inflow number, but that should also be kept in mind. I actually counted there were only 18 working days in November.
Interesting.
Right? There was Diwali and the month started with weekend and then there were 2-3 more holidays and it ended with a weekend and those kinds of things. So only 18 working days in November. Second thing, I don't see any sign of redemption. There was no such exaggerated, nothing unusual I observed, but yes, I did observe that the gross equity inflow might be
a little lower.
A little lower. Yeah.
Interesting. But I think I'm curious because I also heard that the net number is not going to suffer too much.
Yeah, I mean, and I always insist that we should see gross number, redemption and net separately. So that because we know the actual, because each of those is a variable. Net is just, net, it doesn't say anything.
Aashish, thanks so much for joining me in studio. Pleasure speaking with you as always. Insightful conversation.
Thank you.